Welcome back. Markets are holding on. Rupees below 53 and Nifty is sitting above 5700. The bank Nifty also is looking stable and quite charged up. Let's talk market fundamentals, and my next guest on the show, well, I always like to call him the little master because he is one of the best mid-cap stock pickers in Indian markets. Kenneth Andrade, Chief Investment Officer with IDFC Mutual Funds. Kenneth, before we talk about your fund, your investment philosophy, let's understand the broader market environment. September has been an extremely rewarding month for Indian markets, and October, locally and globally, we have hit a pause button. So do you think the current consolidation is here to stay?
Well, just from a perspective of fundamentals, I think you are in the right in the midst of an earnings season, and the quarter numbers that you will essentially get delivered over the next couple of days would basically be a sequence of events that's taken forward from the last couple of quarters. So I do not think there's going to be a dramatic improvement, but in the way results are going to be declared. But on the other hand, I think this will be a base quarter to work with going into the next couple of years. Okay. And that's going to be a significant event. I think we all know about the stress in the system. We all know about the inability of corporate India to put in incremental capex. We know that the consumers are going through a cyclical slowdown. Everything should show itself up in this quarter's numbers. And if you look at the first couple of numbers that came through, it goes forth saying that it's a consolidation period. There's nothing that's going to be surprised. There's nothing going to surprise you on the upside or the downside this time. Expect this quarter's numbers. And if you look at the first couple of numbers that came through, it goes forth saying that it's a consolidation period. There's nothing that's going to be surprised. There's nothing going to surprise you on the upside or the downside this time. Expectation levels are very low, and corporate India is more than willing to meet up or step up to the challenge. So it's going to be quite an uneventful quarter. The sentiment is good. The rupee is found some kind of stability, and hopefully, if it maintains this way, we should see a far more stable market going forward.
But Kenneth, what is your sense? Do you think earnings will bottom out this quarter and we will see better performance from at least the IT names, the first of the lot to come out with earnings?
I mean, it's different for different industries, okay, but the very large part of the investment economy, you should actually see a bottoming out of the earnings cycle in this quarter. But it's not going to revive itself. I mean, it just can't be a hockey stick kind of an improvement in that economy. And that's the economy which you talk about, the banks, the public sector banks, and the infrastructure business and the cap good business. When it comes to the offshoring business, I mean, which is IT and a number of other companies along with it, you would see a fair amount of consolidation happening in that business, which has been happening over the last couple of quarters, and it's very company specific and it's very eventful in that matrix. Okay, so that's what's going to happen in the offshoring and IT space. It's going to be very company specific more than taking a call on the broad economy. And when it comes to a consumer part of the entire economy, led by the consumers out here, that part of the market is going to be fairly. You'll probably see a slow quarter. You'll see a slow quarter, but I don't think that's going to be the norm. That should step up going into March and 2013 onwards.
You know, Kenneth, I track your portfolio with a magnifying glass, and I've often complimented you for your stock-specific strategy. So let's talk about your current portfolio construction. You are still betting on consumers. Your top three holdings are Page Industries, Asian Paints, Bata, Glaxo Consumer Healthcare. Why are you still holding to consumer names? Because they are optically now looking expensive.
Okay. Nico, just to put things in perspective, this year, calendar year 2012, we haven't done anything with our portfolios dramatically across the entire fund house. If you look at any of our portfolios, the underlying constituents haven't really changed. we are essentially looking at or the trade that we put into play in 2011 and 2012 is put money into businesses where you do not see too much of balance sheet risk, and that inadvertently went into the names that you just mentioned. Now there's no deterioration in balance sheet out there, and what has happened over the last 1 year, the stocks have gone nowhere or those companies have gone nowhere, and you've had some kind of a time correction in those businesses. There are no new entrants, and I think the biggest challenge now going forward is, will growth step up? We think 2012 and 2013, that is September, December, and probably some part of March quarter, will be a season. It will be kind of a slightly sluggish year or sluggish quarters for most of these companies, and therein you'll have the pace of growth actually step up. So we're not changing our view dramatically. We still think that leg of the economy is probably the most robust. It is completely deleveraged from this standpoint. You have no new entrants into big categories that are there, and the largest player in the entire business still tends to dominate and has the pricing power. So the reason why we bought any of these underlying businesses it still remains pretty much valid. And if I focus on the macros, I think there's a lot more money getting transferred into the hand of the end user, even today and even going forward into the next 2 years. So that metric shouldn't really change for us.
The other prominent theme you're betting on is agri. So you have a large exposure to Kaveri Seed and Company. Now I know who's buying the stock because the stock run-up has been strong. A little exposure to Coromandel International, a decent exposure to Tata Chemicals. Why are you hot on agri?
Okay. Well, if you, I just say the same thing. If you go back to our portfolios 2 years back, you would have seen the same names and the same quantum of stocks. Why it has come to head the portfolio is essentially the mark to market. So I wouldn't like to comment whether we participated in the run up or not, but it's been there for the last 6 years now in our portfolio with no change in the ownership.
When you say that your portfolio has not changed, I see State Bank of India there. You've not liked PSU banks in the past.
Yeah,
I'm sure this is a new one.
You have about 30% of the portfolio that undergoes a change, but I think largely 70% of the portfolio is still very much static from where we started off, and that will go with the underlying price points at which these companies are available. So if you step back, we had some of the large contractors on board at the beginning of the year, but that again was from the price point that it was available at. So these are opportunistic. I guess some part of this market is reasonably opportunistic, and some part of the market is where you buy and you hold, and you wait till the business models actually play out. And that's where we've taken the former names that we mentioned about, whether it's any of the agri numbers or any of the consumer plays that we bought into play. And that's how we put it together.
Ken, you're betting on a liquor company, which is United Spirits. Is this a value call based on the dynamics of the liquor industry, or this is a deal call?
No, it's been there. That's also been there for quite some time. Actually, it's been mark to market, which has come to the forefront, and it's been around with us since I think 2008. But it's largely a very part of the entire consumer-centric basket that we are looking at. The developments out there are fairly in favor of the company if all works out right, and it's a fairly large company if you just break down the numbers, and if you just break down the numbers into how much products he actually sells through the entire system. So we're trying to align ourselves with the largest in their entire categories, and at the other extreme of the portfolio, we're trying to find out whether there's a number 2 or number 3 which is relevant in the entire system. So like you initially started off, said that the consumer is still a very dominant part of the portfolio that we run, or the portfolio which is the IDFC Premier equity portfolio that we run. We're not undergoing the change in the portfolio today. At the bottom end of the portfolio where you see the churn happening, we've tried to align ourselves with the investment economy, purely because the valuations are right. But unfortunately, the cash flow in the system is still struggling. So So it's unlikely that that part of the portfolio is going to be very big in the near term. Okay, but that's how we normally put this portfolio together. We have a dominant theme that plays at the top end, and we start building a part of the business where we find valuations comfortable. We do not see too much of underlying risk to the business, or a lot of it is captured, and we put it together at the bottom end. So hopefully going into the next couple of years, if the bottom end of the portfolio is stable and they start generating cash flows, that part of the portfolio should flip itself to the top. That's what typically happened in the first cycle with this portfolio. So hopefully going into the next couple of years, we should have a very similar metrics playing out in the next 2 or 3 years.
Kenneth, what about the cement pack? Do you think that sector is going to continue to outperform, at least in the short term?
If I break down the matrix of that business, it's a fairly consolidated environment. Okay, the top 2 players in the industry have got very clean balance sheets and are not leveraged at all in going into the cycle. And there is fair amount of pricing power in the entire equation, and capacity utilization in a certain amount of the country, certain part of the country is extremely high. So very clearly demand is essentially driving it. You can always question valuations, but till there is no deterioration in the broader economy, I think reasonable amount of money will continue to get parked into this industry, given the fact that there is no near-term risks to the business environment.
Right, so Ken, what are the new structural businesses you are betting on? You know, fund performance is also about generating alpha. Where how do you propose that you will be able to generate superior return in next 6 to 12 months or beyond that? So which are the businesses, sectors or groups you are betting on now?
That's a little difficult to take a call right now, because most of these sectors do not tell you they are coming. But if I just break up what we're trying to do, I don't think I think most of the portfolios across the industry and across a lot of individual portfolios will migrate towards the dominant part of the market. It's always happened. You step back to 2000, it was technology. You step back to 2007, one way or the other, it was the investment economy stroke infrastructure. And going into the next couple of years, despite the stretched valuations, I think it will continue to be the consumer and that pack of the entire market will continue to be the dominant theme as it plays through. In terms of structural changes that are happening, I think a lot is happening on the investment economy, but you will have to approach it with a very stock-specific approach rather than taking it saying infrastructure as an industry is good, because there will be a high level of mortality risk, and there will be a couple of companies that will come through dramatically. So what we're trying to find in a number of these companies is companies which do not have mortality risk, and where you have been able to price, or you can price the risk of the downside in most of these companies. And I think there are a lot of them out there. All said and done, I think the breadth of the market is fairly good just now. Okay, and when I say the breadth of the market, predominantly the smaller companies may not be in many investors' radar at this point in time, but they've come through with very clean balance sheets, extremely high dividend yields, and no capital investment going forward. So these are cash flow positive companies, not on the radar currently, and that's a space which is very interesting. I'm not too sure if an institution can participate in that part of the market, but yeah, we sure can take a little bit of an exposure here and there. But it seems to be pretty aligned to the fact that the bottom end of the market is completely solvent. The risk now is in finding the last round of capex that went through into 2010. How does the system actually deal with it, and when do they come through the cycle?
All right, Ken and Radha, appreciate your time and thank you for your valuable insights. Pleasure as always to have you on ET Now. Before